Hello, I'm Mario Toneguzzi, managing editor of Canada's Podcast, taking care of business today with Carmin Di Fiore, who is executive vice president of CBRE's debt and structured finance team. Thanks for joining us today, Carmin.
My pleasure.
Okay, we're going to talk a little bit about a recent report that CBRE put out on the real estate lenders report. In general, how do lenders feel about the real estate market in Canada today?
Coming through the pandemic, I'd say, there's a little bit of concerns and hangover from where we were. Obviously, the amount of fiscal stimulus that the government's provided created a very low interest rate environment where we have now seen bond markets respond accordingly. And so I would say that has created an adjustment in terms of valuations and how the investment market is looking at transactions going forward. To answer your specific question, that does raise some questions or issues for lenders in terms of what is true value today, what do the cash flows look like, and how much leverage they should be providing against certain assets.
Mm-hmm. Yeah. Is there any areas, like first of all, geographically, that lenders are more, I guess, more positive about in the country?
Generally, the report indicates that within Canada, really, there's not much change. It's always typically Toronto, Vancouver, Ottawa, Montreal. This year, we did see Calgary and Edmonton move up in the ranks in terms of preference or conditionality. I would say that's probably in reaction to better economic news in Alberta. And so from that perspective, the demographics really don't change and drive the markets. It's really the economics that drive those markets.
Mm-hmm. Yeah, exactly. And what about when it comes to specific assets? What's hot these days, I guess?
Well, given the significant press around housing affordability and thoughts by the government that sit there and say, how are we going to change this? The recent waiver of GST or HST at the federal levels and some of the provinces now subscribing to that same formula are really a bonus to the purpose-built rental markets across the country. I would say that in general, they're relatively beneficial, but from a measurement standpoint, they're relatively marginal in terms of how they're going to change financial returns. Mm-hmm. That's a real positive. The other one that continues to show real robust desire by lenders is industrial. Yeah. The logistics markets are really a pretty good place to be these days, and there's a lot of sensible lending going on there. I would say those are the two most desirable. We're seeing continued support in food-anchored retail. And we're actually seeing enclosed malls starting to do a pretty good business post-pandemic. So yeah, that's weaving into it. I would say if there's one negative these days, it has to be the office markets. And lenders are still trying to figure out how that is going to fit in going forward, whether it's a 5-day work week, 4-day work week, or 3-day work week. So there is some fog around office assets. And it also is compounded by the fact that we delivered a pretty significant amount of inventory at the same time. So here we have not only the cautionary approach to office, but an overhang of office inventory.
Yeah. What as you look forward, what's the prospect for the office market? We got places like Calgary that, still in the 25+%, vacancy downtown. And, a lot of the traffic to downtown still isn't where it used to be, right? So what are people thinking about that market going forward?
Well, specific to the Calgary market, the boom in that market was created by oil exploration. Yeah. And when we were at $100 a barrel, that has fallen away. And so, the problems in Calgary are unique to Calgary. I would say that the issues in the rest of the country are just basically, how much of this is a social change in a norm?
Yeah.
Are we going to a 3 to 4 day work week versus a 5 day work week? I'm not sure that's been figured out yet. And so what happens is that investors, i.e., the institutional equity that's typically behind many of the offices, are basically sitting there saying, let's wait a while and let's figure this out and let's see a more robust return.
Yeah.
In the interim, what it does is there's a flight to quality. There's a flight to better amenitized buildings and super core buildings and how they function. And certain buildings that have seen a better day and become somewhat obsolete in this market will have to be either reconfigured or basically razzed and used for another purpose.
Mm-hmm. How would, when you look into 2024, how are people feeling about, what the economy is going to look like? I see today that Statistics Canada has come out and said that there was a slight decline in the GDP nationally in the third quarter. So, what are the thoughts going forward on the economy?
It's funny you mentioned that. We have come through a cycle where we went from 50 basis points to 500 basis points. And if you were to put this in terms of an earthquake, it's pretty seismic in terms of going that quickly and rapidly. And what it has a tendency to do is, in such a violent upheaval like that, a lot of things fall off the shelf. And so really people are not able to readjust their spending. Businesses have to adapt to higher interest rates.
Yeah.
And so it's happened in such a compressed period of time that really there's an adjustment. Frankly, we had to get in front of this inflation issue. And, based on what we're seeing in the press today, it is working. Unfortunately, there is a cost to that, and that could be a recession.
Mm-hmm. All right. Well, thanks very much, Carmin, for joining us today.
My pleasure, Mario.
All right. That was Carmin Di Fiore, who is Executive Vice President of CBRE's Debt and Structured Finance team. I'm Mario Toneguzzi, Managing Editor of Canada's podcast, Taking Care of Business. Thanks for joining us today.